Welcome everyone. My name's Jamie Nemesis and welcome to Market Thinkers Series 3, Episode 5. As per usual, I'm joined by my business partner, Drew Meredith. Afternoon, Drew.
Afternoon, Jamie.
And our guest today is Simon Redman from Invesco Real Estate. Hi, Simon.
Hi, Jamie. It's great. Good morning.
Good morning.
It's morning. I think Simon's joining us from London and it's 5 o'clock in the morning. So thanks, Simon, for taking this call.
That's a pleasure.
This series is dedicated to the theme retirement. As most people know, Drew and I run a private wealth management firm in Melbourne, and our focus is on retirement. Generally, our clients are plus 60, and generally we're managing the last third of their life or the capital for their life. This series being around retirement, one thing that we talk a lot about to our clients is a simple formula, which is total return equals income plus growth. Really simple to understand, but lots of the concepts of managing retirement money can come back to that. Over the last 4 or 5 episodes, we've talked about either income or growth. Today, we'll be talking about both. We're talking today about real estate and property and where that fits into retirement portfolios. And Simon, of course, is our expert today. Drew, can you provide a short introduction to the session and to Simon?
Yeah, thanks, Jamie. And good morning, Simon. I think good introduction is kind of one of our guiding principles at Wattle is to try and bring an institutional rigor or an approach to mums and dads and the portfolios we help manage. So when we talk institutional, we're talking about endowments, big pension funds, universities, and there's certain things that they bring to investment, which is things like discipline, structure, rigor in analysing, but also the quality of assets. And that's kind of my segue into Invesco, where real estate has been a core part of institutional portfolios for decades, since they've existed basically. But it's not about buying, an investment property or a single syndicated building. It's about, having exposure to all different parts and all different sectors. So we've kind of, after looking across the market forever, we settled on Invesco, given their kind of background in institutional grade property. On that basis, I wanted to introduce Simon and get maybe a bit of background on where your career's led you to, how your career's led you to where you are today, Simon.
Great. So thanks, Drew. And look, it's a pleasure to join you. Well, this morning, my time, afternoon, evening, your time. And the introduction from yourself and Jamie was tremendous. I've been involved in institutional real estate for most of my now 31-year career, which started, actually my career, I originally qualified by taking a land management degree many years ago. I qualified as a surveyor in the UK, and then moved more internationally when I did an MBA to focus on some of the more investment side of things. I've been at Invesco for the last 15 years, and having had fund management roles there, corporate finance roles, client-facing roles, I've had quite a big mix. And about 4 or 5 years ago, what I saw or what I wanted to do was to really provide the opportunity for your types of clients access to institutional real estate. And so I started the program at Invesco of putting together a number of funds in order to provide that access to your client base, really your type of clients globally, to institutional real estate. It is something which, I really wanted to allow anyone to be able to invest in the sort of real estate that the biggest, most sophisticated institutional investors get access to worldwide, which, hitherto wasn't really possible so easily.
And what does institutional look like compared, we will say, investment property versus a building, but what does it look like? You're talking about global scale. I think you manage something like 80 billion in assets across the world.
It's a good point, Drew, and Simon mightn't be aware of the Australian market, but a lot of our competitors in this wealth management space and a lot of clients have single syndicate funds. So one property, closed syndicate, it'll either go for 7 years or 15 years. And essentially there's no liquidity. You might be buying a regional shopping centre and then you have to buy another one and another one and another one to complement it. So, and it's actually a really popular marketplace in the Australian landscape. So maybe if that gives you a bit more background before you answer the question between what is retail
Yeah, sure.
and what is institutional.
Absolutely. Well, when I'm thinking about institutional, I am thinking about larger portfolios. You know, as a firm, we manage over 85 billion. In terms of the opportunity we can afford to your sort of clients, that's a portfolio of around $28 billion US dollars globally. So what's the difference between that? Well, a syndicated building in Australia is perhaps fine, but you're putting all of your eggs in one basket. You know, and the Australia property market goes through different cycles. What happens globally is that the property market cycles are very different. We're also typically investing in much larger buildings. So the average investment size of each individual building that we have is about $140 million. That's really, even for syndicates, that's well beyond the scope of most investors. And the reason why that's important is that typically large buildings like that attract for us one of the best quality tenants. So, you know, you said at the beginning, Jamie, when you're looking at total return, income, and appreciation, the two components, we look very closely at the quality of that income. And so by attracting the best tenants in the best quality buildings, institutional quality buildings around the world, we get access to that very good, very stable income. And through the pandemic, we've seen how resilient that has been compared to probably what you might have seen in sort of syndicated shopping centers, for example, in Australia. It's a very different investment.
So you're talking about tenants that range from like a Microsoft, maybe not Microsoft, but you know, the biggest Fortune 500, S&P 500 companies to, you know, mum and dad shops,
exactly.
Or not that broad.
No, it's pretty broad, but Microsoft is one of our tenants.
Yeah.
It'd be the likes of Microsoft, Amazon. You know, we focus on these days on some of the more technology companies, the key growth companies. For example, in South Korea, where we let one of our large buildings in Seoul through the pandemic last year, that is to the largest South Korean technology company, all the way through to some of the largest banking and finance companies as well. What is key to us is underwriting the quality income to make sure that's very resilient. It's quite often, I think, a different approach to just syndicating a building where, you know, you may look at the tenant quality, but for us, we're absolutely focused on that, you know, institutional grade, if you like, income, which you might find in a more fixed income portfolio, and then look at the building as well to make sure that has future growth opportunity as well.
So when a client goes into your fund, what type of properties are they getting exposure to, and kind of roughly regions?
Yeah, so and this is another important bit about opportunity. So I'll answer that in reverse order.
Big question, really, wasn't it?
Yeah,
You got 20 minutes.
I know, and the danger is, you know, I can talk about this forever. But if you think about it, the Australian market is relatively small. It's probably only 2% of the global real estate or property market. And so part of being global is just the opportunity set. We've got a much bigger opportunity set to invest in. And the fact is the Australian property market does not reflect what's happening everywhere globally. There are different opportunities, different cycles. And to answer the first bit of your question, when we're looking at different properties, we are still focused on the similar main sectors that you'll be familiar with, being industrial, logistics, office, retail, maybe residential, although that tends to be a smaller institutional part in Australia, much bigger elsewhere. But within that, there are other key sectors which are the subsectors which are phenomenally important. So the focus today on things like healthcare in the US, which has got very compelling attributes. It doesn't really exist at scale in the sector in Australia.
Is that like hospitals? When you say healthcare, is that what you mean?
It's a healthcare, not quite going to the kind of acute treatment of hospitals, but this is more where you can actually, well, part of the definition is that you can walk in and walk out. You don't arrive in an ambulance. is one of the ways of thinking about it.
Got it.
And you know, and one of the reasons that's very compelling in the US is that they've got an aging demographic. In the next 20 years, the number of people over 75 will double, increase by about 20 million. So think about that in the scale of the Australian population as a whole. and the healthcare is privately funded. So that increase creates a demand for more medical facilities, and it's undersupplied. And so we're investing alongside those long-term demographic trends. So again, going back to your syndication, what we're not doing is just trying to find a building we think is attractive, but first of all, we're looking at long-term secular trends that drive investor demand over the long term, and that helps derive our strategy. So there are just sectors which are not possible to invest in Australia.
How's your portfolio evolved over the last 5 or 10 years? So have you got parameters around industrial versus commercial versus residential? And has it changed much in 5 years?
Yes, when we're looking globally, it changes both in terms of the emphasis on those different sectors I talked about, but also we change our allocation to different regions and different countries.
Yeah.
That goes back to the point that not all property markets are the same everywhere. You want to be overweight, if you like, to some markets sometime, underweight other markets other time, similar from a regional perspective. So it changes quite significantly. Today, we are very overweight to the US with about a 45% allocation. We're overweight to Asia Pacific and underweight to Europe. Now, we've really benefited from that recently with very strong performance in the US recently, but that allocation will begin to move over the next 9 months or so. It's a long-term asset class, and we'll be down-weighting the US over the next 9 months, increasing our allocation to Asia and then to Europe, and probably in that order.
How do you do that, Simon? So assume if there's a next dollar into your fund, you're looking at how do I allocate that? You must have an enormous amount of array of opportunities to invest into, from sector, geographical location, and how does it work internally? Do you have an investment committee that says that investment, or a team, or how does the next dollar get allocated in your world?
We've got the great advantage of scale. So the next dollar you to invest, let's say it's $1 million, just to give a sense of scale.
Bigger than dollar.
Investing $1 million in a $28 billion portfolio, which is what you have, is pretty easy.
Yeah.
That's sort of like the change you find behind the back of your sofa. So being able to deploy that capital, we can do immediately. It doesn't mean we have to go out and buy a new building each time. We don't need to invest that new building each time. We can absorb that capital. But what we do is in terms of implementing those change in allocations, change in region, is that we've got over 600 real estate investment professionals in 21 offices and 15 countries around the world. And the job for those people locally is to tell us where they think the best opportunities are in their particular markets. And then we have our regional teams. Their job is to make sure we get the best allocated in each region. And then globally, part of my role is to ensure that we can make the best regional allocation. So we're taking the best of the best, if you like, at each level, and being able to get those allocations right. It's impossible being global to know everything that's going on everywhere. So we rely very, very heavily on our local teams who are in those markets. And you will know, just being in your own market in Melbourne, or for those who may be dialing from Sydney or elsewhere, you will know that each individual market's got its own nuances. We've got experts in all of these markets, and ultimately we layer on that expertise to get absolutely the right allocation.
And when you're talking about absorbing, that kind of includes capital expenditure, doesn't it? Where you can improve a property and ultimately increase the rent coming from it as well. Is that kind of a
absolutely? Yeah, and that's why we have experts in terms of transactions, of buying, investing in the right properties. We also got a separate team, an asset management team. The DNA is a little bit different. The deal doer is a bit different, got slightly different DNA to the person who is managing that asset to try and maximize opportunity. But every time we make an investment, and this is a key part of our investment decision making, is there's a business plan. And the business plan for every single building we have is to try and increase value. We never invest in something and then hopefully sit on it and hope for returns to arrive. Every time we have a business plan. So that may be doing relatively little, but looking at the market, but it can be going through a refurbishment, taking in new tenants, improving. Today, what's very important is improving the environmental credentials of a building. That adds a lot of value. And we've just had our recent GRESB scores. GRESB is the global benchmarking service for sustainability in real estate. We've improved at every level, and we've got some of the best funds in the world. So actually just the environmental things today, improving energy usage, waste diversion, that actually adds investment value today. It's a key focus of ours.
You kind of alluded to it there too. How different is it doing a due diligence on a Singapore office building compared to one in where you are in London? I assume you're in London or nearby.
It's very similar. So the investment process we have is exactly the same globally.
Yeah.
It's important that we can look at the best relative value in exactly the same way. We need to be able to judge potential investment performance in exactly the same way around the world in order for us to make the right decisions. We're very unusual as a manager. A, being global is unusual. There aren't very many of us. And B, having exactly the same process. So it's identical. There are different legal nuances, different leases and things, but the process is the same. The approval process is exactly the same.
And you also include some listed, so you got listed and unlisted in the Australian strategy?
We do. And actually, this is a strategy we manage globally. So whilst we have it set up for Australian investors, we also have investors from the UK, where I'm sitting, Switzerland, the Netherlands, the Nordics, Canada, Singapore, Hong Kong, Israel, where I was last week, global investors. And we also mix institutional investors with your sort of clients. So the comfort is that also that we get a lot of institutional capital coming in there as well. So we're bringing the two together. And yes, we do have some liquid assets, listed securities in there. And that provides the ability for investors to invest every day. You can subscribe to our fund any day. That capital or that investment will immediately be deployed, probably in securities initially before being directed into direct property. But that isn't just REITs or even global REITs. We invest also in real estate debt, real estate preferreds, if that makes sense to your kind of investors.
That's one of the ways Drew talked about how we selected the Invesco property fund for our model portfolio. But one of the things that you're doing that other funds aren't, and you've got to be really careful with this because there's been many train crashes over the last 50 years, but you're providing liquidity in a property, in a non-liquid investment, essentially. So for our clients, we can invest into it and we can get our money out of it, depending on market conditions, and some of those elements, just sheer size and the fact that a part of your portfolio is invested into listed securities allows you and your group, I assume, to give our clients the benefit of liquidity.
Yeah, that's right, Jamie. And I'm very aware of some of the challenges funds have had in Australia and other places around the world when designing these funds that we have. We were very aware of that, and some of the differences we have. One of the key ones, as I mentioned, is that we have global investors in our portfolio, and a majority of that capital is very stable, long-term institutional. Where there have been the train crashes, as you refer to, typically they're in domestic funds, almost exclusively, in fact, investing in one country into one type of investor. So in Australia, that'd be investing predominantly in Australian property with all Australian investors. And, there's a mindset that people make the same decision, the same call on the Australian market at the same time.
Yep.
In global property, there's less reason to do so because the market cycles are very different. And we've got investors globally. So,
and does currency help too? Currency must help balance all that risk out.
It does. We typically look to hedge some of the currency exposure. And we're not trying to play currency markets. We're real estate experts.
But we know currency is always a kind of a buffer in crisis. So
it does help a bit, because it's very diversified in terms of currency as well. But we're trying to play real estate markets. That's our expertise.
Sure.
Currency, we'll look to hedge much of that.
Yeah. And talk to us about the new sectors that are emerging. There used to be a a warehouse kind of sector that no one ever wanted to touch, but now it's called big box and, data centers and everything that's super cool. Is that a sector that, your group is investing into, or you find, as an exciting change in real estate?
Yeah, look, and real estate's been the same forever, hundreds of years. The way people use it are the same. You need somewhere to operate your business, to connect with people, to innovate, or to live, or to consume, click as we call it. But actually what changes is secular trends, whether that's online retailing, life science growth, technology growth, demographics, aging. And so those are the things we follow, those long-term demographics. As I said a bit earlier on, we're not just trying to find a building and hope it makes sense. We're fitting it into that secular framework. And to your point, that means there are different opportunities and they change over time. So today, we're very focused on technology innovation sectors. We like the life science sectors. We like online retailing, although that's not new. And what you're referring to is industrial or logistics properties, which provide that online retailing. That's been around for 2 decades.
Is that the word dark? Is it dark? They use the word dark
stores, or
dark stores, or do they use that in?
Dark stores tends to relate to food retailing, when they've got dark kitchens. But this has been around for a long time. And what's interesting today is that different markets are at different states of maturity. So the online retailing penetration in the US and the UK is probably the furthest along. The UK is probably, well, I think it is the most biggest penetration, where over 25% of all retail sales online. But what's interesting to us is that a lot of the markets are a long way behind relative to that. So those are other markets in Europe, such as Spain and Italy. Other markets are in Asia are behind that as well.
I think we're 12%. That's it.
Yeah. Well, there are good reasons for that, which I could go into actually. But the thing is, we can then look at those more mature markets. We can learn, and we have learned lessons from those, and we can apply those lessons as we invest in other newer markets, less mature, creating better opportunities or newer opportunities around the world.
So this is sorry, there's a more bank. Have you heard of Cube Holdings? I think Logos is a big Southern Hemisphere infrastructure owner. So they have a more bank terminal in the middle of New South Wales. It's probably the kind of idea you're talking about there.
It is. So the challenge with Australia is your population and scale. So in the UK, which is around 70 million, we're a pretty small country. The cost of actually distribution, taking something from a warehouse to a person, is pretty low. The distances in Australia, because of your overall location, are very big. So that creates different economic challenges for the model, which is why Australia has been behind. Is because the model's easier, online retailing model is easier to execute in a country like the UK than it is for Australia. Australia will catch up, but we've got all this experience around the world when we're looking at Australia to make investments in, with the benefit of knowledge many other people don't have, because we take it from elsewhere. And we can also deal with some of the biggest companies. Amazon, for example, biggest online retailer outside of perhaps China. We have got a lot of fulfillment centers, which we've either constructed for them or they occupy. So we have that direct relationship with them, which frankly, an individual syndicated building will never have. You've got to have that scale for that relationship.
If that's great on the way in, Simon, how do you decide what you exit? Because building relationships are really important, and getting in on ground zero is great to build the building purpose. How do you then make that sell decision? Go, okay, is it cap rate? Is it something about assets? Is it better opportunities? What makes you sell an asset?
Well, first of all, I said at the beginning, we look at buildings in exactly the same way globally. Part of the investment decision making to go in is actually how we go out. It's very important to know what your potential exit is before you even start investing. You shouldn't put any store in hope value. That doesn't really work. You need to have some idea. And so every business plan for every building we have, we're thinking about the exit and what that sale decision is. And we have every single property around the world. We have metrics we're looking at. We reanalyze that roughly every 6 months. And if the future returns from a building that we have don't meet the thresholds that we've set in terms of income or total return or opportunity, then that is a potential sale. No building in our portfolio is sacrosanct. You've always got to be thinking about a potential exit and how you get out there, how you get out of that investment. And it's when the future returns don't meet our hurdles, then we'll be looking at a potential exit. So what does that mean in practice? It means the average length of time we hold a building is around 7 years. And so we're always investing and selling buildings because we're looking to maximize the opportunity for each one, maximize that business plan from each individual property.
So we've got a question come through. A good segue is probably you're talking about the domestic macro environment. It's just as important when you're selecting or selling assets. So we've got a question around bond rates. Naturally, we had an explosion in the 4-year Treasury bond last week. If you saw that, how important are bond rates in terms of your valuations? And everyone's talked about in Australia, people are talking about the risk of residential property if interest rates increase. Bond rates versus interest rates, different things, obviously. How important is it? Does it keep you awake at night? It's the follow-up question.
Short answer to that is not particularly, no. There are, just to answer the kind of interest rate question, interest rates globally have been incredibly low. What's helpful for us is that the spread, if you like, between property yields and bond yields around the world is in a very normal range, and in some markets is as wide as it's ever been. So what that means to us is that we can see some interest rate rises occurring, and that's being talked about around the world in different places. That'll have very little effect in terms of the pricing of our real estate. And it is worth now making a big distinction between the residential, where people kind of live or individuals invest in, and the commercial property that we invest in. They're very different asset classes, really. So I'm not terribly worried about interest rate rises. We have a little bit of debt in our portfolio. It's very low. It's around about 25 to 30% loan to value.
Does that cost you, Simon?
Sorry?
What does that cost you?
Borrowed in Japan or?
Well, we borrow in Japan, we borrow in Japanese yen, and that's, you can say that's pretty accretive to returns. But that's also 2,000 of it's fixed. So I'm not worried about short term. What does interest me perhaps a little more is the broader, looking at more broadly in terms of those macro trends. You tend to get interest rate rises in order to try and control inflation, which is what's happening at the moment. Now, that's beneficial for real estate. Where we've got the data, historic data, times of increasing inflation have been very positive for real estate. The last 3 times, for example, significant inflation in the US, real estate's outperformed by 800 basis points. And so if you think through that,
outperform what benchmark?
Has outperformed what we've seen in terms of inflation. So, okay. So when you've got an inflationary environment,
so the inflation of 4, real estate's typically done 12.
Yeah. And that's it's kind of intuitively makes sense. You tend to get an inflationary environment where economies are doing better. That's why people are rising interest rates, well, just to keep a bit of a lid on that. Well, that increases demand for property. So as long as there isn't a big development boom, which we don't have anywhere really around the world, and in fact, rising commodity prices will restrict development, most likely because of the cost of building. That's actually very good. And so I don't really worry about that. And one of the questions we often get is property a good hedge for inflation? It's not a great direct hedge, but actually property in inflationary environments tends to outperform, which is a good thing.
Particularly when you've got some flexibility, I guess, that you're not just buying the same property and holding it for 20 years. You're selling some in some countries where maybe the economy is doing better and there's interest rates are falling, and that's kind of the benefit, isn't it?
Exactly. When property values were falling during the pandemic, what we saw was to be relatively close to home to you, in South Korea, our property values were increasing, for example. And so that is part of our job, is to make those right allocations.
And most leases have got inflation hedge, inflation linked to them?
It varies. Leases are very different around the world. So some are implicit, so they actually have inflation linked to around the world. Others are linked to the market rent. But as I say, in an environment where you're getting strong economic growth, you're getting demand for real estate, rents tend to go up. We want to capture that. So we actually like the opportunity when we get leases coming to an end, or when there are reviews or bumps, depending on how you describe them around the world, where we get the opportunity to review. We like to capture that additional rental growth. It gives, from your kind of client perspective, the income tends to be more of a real income. So it tends to increase where you get an inflationary environment. As I said, it's not an absolute link or correlation, but you tend to get that growth. But that's really helpful if you're looking for your future retirement, I would think.
I'm kind of interested in some sector questions, if that's all right. So with Australia's, we had a second lockdown this year, as you probably know, in Melbourne and Sydney. So everything seems to be 6 to 12 months behind what's going on in the UK and the US. So we're still talking about, Jamie and I are in the city today. So are CBDs dead? Have they recovered? If you've got assets in every country, what does activity look like in the UK versus Asia? What have we got to expect?
Well, it would be great if I had a webcam and I could have fast forward about 4 hours in the UK to our office and what's happening in London. It's as if there's no pandemic. People are back to work. I got the train into work yesterday. Everyone mask wearing, of course, but it's as busy as it's ever been. And that is a trend around many markets around the world where they've opened down and not in lockdown. I said I was in Tel Aviv last week on business, incredibly busy as well. So what we're seeing is when people can, and Asia Pacific is probably furthest behind. Well, not probably, it is furthest behind in terms of coming out of this. But my experience around the world is that businesses, people, countries want to get back to normal as far as they can, and it happens very quickly. From an office perspective, to be specific on that, offices aren't full in many places, but CBDs are typically the most busy areas now, and occupancy is getting very, very much back to where it was. And we think, for good quality buildings in CBD locations, we don't really see any particular challenges from a COVID perspective, a pandemic perspective, or changing working practices. Those which may be affected long term with working from home are going to be those which are a bit more peripheral, more secondary assets, less good quality tenants, which I'd expect. That is why we focus on some of the best buildings, best locations around the world, and best tenants, of course.
Markets are funny, aren't they? Well, they all kind of operate in a similar way. In the last 18 months in the Australian share market, we've seen all these companies, a whole heap of companies, double, triple, quadruple their valuation based on the spike that has been created around COVID. And guess what? They've come out 12 or 18 months later with downgrades because it was a one-off, similar to residential remote property in Australia at the moment. If you want to buy something down the beach or on a farm, it's gone up 100%, 150%, 200%. And, the core, what I would call core real estate, we're talking about residential here, 10 kilometres from CBD, hasn't necessarily moved too far. So there's this big structural shift of what people are prepared to change and pay for, because they assume that then work-life balance is going to be balanced like it is in COVID. We know whatever happens, at some point we'll look back at COVID and say, oh, well, that was a fun period in time, but it's all changed and it's gone back to normal. Real estate, doesn't matter if it's shares or real estate, does it, that people get really a lens that they look through, which is all about today and never about tomorrow and the next day and the next day. And you must find that in real estate too, where, you get all these pressures about today's environment and inflation and whatever. And when you're trying to build really successful long-term portfolios, it's just more noise, and there's a lot of noise, and noise can make money and it can lose you a lot of money, but to stay focused is really important.
And Jamie, that's why I was saying that we look at long-term secular trends, because that is what really drives long-term value. Trying to make that short-term bet, that's a tricky game to play. So we're looking at those secular trends, as I said, demographics, still the work-life balance, that flexible working, that's been a trend for decades as well. Some of you will remember hot desking. That was a new thing a while ago, but that was about having more flexible working. And so,
sure.
What the pandemic has done hasn't really changed anything for us. It's accelerated some of those trends we were already investing in. So flexible working is one of those, having buildings to suit flexible working, the demands of companies that want that. That's absolutely been central to part of our investment in the office sector pre-COVID. Environmental ESG concerns, fundamentally important. And we've been having that as part of the lens we look through for the last 15 years. It now adds investment value. So all of these things are part of long-term secular trends, not that kind of short-term. And frankly, it hasn't changed our strategy at all. The pandemic has accelerated some of the trends, which for us is great. We were positioned for that. And I think we'll end up coming out of this, and we are already out of it in some places, in a much stronger position than we went in.
All right, so you go, Drew, because I've got a fun question to ask.
I've got another fun one too. So just on broad valuation, how's property values look now compared to 2 years? So we even knew about this virus coming out. Around the same? I know you probably need to go US, Asia, Europe, or
no? Well, we're generally higher, so we're higher than we were pre-pandemic. Some useful kind of stats that may be useful for your listeners or your viewers is that in terms of occupancy, our portfolio hasn't changed in terms of occupancy over the last 2 years. In terms of number of tenants, our number of tenants have actually gone up over the last 2 years.
How many is that? Like 150,000 or something?
Well, in that 28 billion portfolio that your clients could invest in, we're about 2,100 tenants. That excludes the residential, obviously, but commercial tenants, 2,100, give or take. And income is higher than when we went into the pandemic. So just if you look at performance, for example, the last 12 months, property level performance, we're up this year by about 13% in the last 12 months. So it's been we had a small downgrade in terms of performance or valuations through the pandemic, but it was pretty slight, nothing like compared to what you saw in the domestic Australian property market. And now, as I said, we're up very significantly, both in terms of income and appreciation.
That's probably a follow-up I'll still want to get is how often are you valuing that portfolio? So you do a desktop valuation, which is something
only when it goes up, Drew.
Yeah. No, look, we don't do any desktop valuations apart from for our own investment decision making. Every single property, which today is about 208 in this portfolio. That's why the average size is around 140 million. They're big properties. They're externally valued every 3 months. We have no influence on that at all. So they're all externally valued, and if you like, marked to market on a quarterly basis externally.
A pretty good customer is it CBRE or someone like that?
Well, so put it another way, we've got pretty good negotiating power as well.
Can you talk about the residential sector in the US and what that looks like? So build to lease, or it's different than the Australian market. Can you put some color around that sector? Family, what's it called?
Yeah, multifamily is called in the US. Yeah, or it's got different terminology around the world. I give you the American terminology. So multifamily. That's been a sector we've been investing in the US since the early 80s, which is where it really developed in the US. And that was down to affordability, more people wanting places to live than they could afford. So it developed in the early 80s. It's a very mature sector. Today in the US, we've been overweight that sector for many years. And again, that's down to the kind of secular trends. You've got increasing population. It's expensive to buy in the US as it is in Australia. I know yields are very low in Australia as well. And so people rent, and it's normal. It goes up and down a little bit over time, but those fundamentals remain very strong. And so we continue to like the residential sector in the US. Multifamily, meaning they see blocks of apartments that we manage centrally, is the core of that portfolio. But increasingly now, what we're doing is focusing on what we call single family homes. And so if you think about the natural evolution, and our target market is principally kind of millennials. And as you grow up, from co-sharing or cohabiting to couples to getting married, perhaps to having children, really having a family, your demands change from wanting to be in an apartment into a house with different amenities. You're looking to be close to schools and those sorts of things. And so we are expanding more into that single family housing as well as the multifamily apartments. That's a big growth sector for us, a big opportunity. And unlike the multifamily sector, which in the US is roughly around, I think, about 80% institutionally owned and managed, in the single family homes, it's only about 2 or 3%. There's a great opportunity to institutionalize that sector and use the expertise we've developed over 3 decades in multifamily in single family homes. But the multifamily sector or the residential sector in the US is very mature, is very institutionalized, is very normal for us to invest in, whereas it's not in Australia.
So there's some stigma to it, right? When I think about multifamily, I'm thinking, a set of flats in a suburb I won't mention that, is not very appropriate. That's not, and I've seen a couple of your assets, that's definitely not what multifamily means in the US, right?
Absolutely not. No, when I was that kind of age, I would love to have lived in one of the apartments that we own. And so we're not looking at super kind of penthouse premium, but typically the way we look at it is look at the demographic, let's say a 25 to 35-year-old demographic, normally a professional. And so, we look at income versus or rent versus kind of a percentage of income typically. And so no, these are very high quality, very amenitized, as we would say in the US. And so given the scale we have, they will probably have a gym. They may have dining areas which you can rent. If your apartment's too small, you want to entertain 20 people, you can rent a dining area and a kitchen. If you go to San Diego, they have these on the roof, which is just amazing. So it's a very different, very high quality, very professionally managed. We have some things in some of these properties whereby you have your Amazon delivery, that'll arrive, that'll be taken in by the management team, and you collect it from the reception when you go back in. So yeah, very different, I think, perhaps, Jamie, to what you might have been alluding to.
And leasing's a bit different there, is it? Is it, Australia, you get no more than a 12-month lease, and then you have to re-up or get out?
Well, again, this varies around the world, but the average stay in the US, the average someone rents an apartment for is somewhere between 2 to 3 years. You'll constantly have a bit of churn. What we did see through the pandemic is, I think this is what was being alluded to a little before, we saw a lot of people moving from, say, CBD San Francisco to out of the Bay Area to kind of enjoy their work-life balance in the mountains or something. And so we saw some vacancy there, but actually that's pretty much trended back again now as people have realized actually they want to get back into the office. So, a 2 years is probably a good way to think about that. Although if you're in Germany, the average is more like 10 to 15 years, interestingly.
I'll put you on the spot. I was reading one of your updates that talked about a specific property in Germany, which I thought kind of explained the innovation that's occurred. I think it was either an old shopping center that was converted into data centers and a mix of retail.
There we go. Yeah, I was hoping you'd find
one. Give you a hint. Yeah.
Which I actually know in detail. So I think you're talking about a property called Neuhopfenpost, and forgive my terrible German accent. I do speak a bit of German, but what that means is the new post office. Frankly, it was new in the 1930s, but it was a post office sorting office, and what we've got there, that's now multi-use. It's incredibly well located near the Hauptbahnhof, the central station. Right on the edge of the historic CBD, and that's multi-use. So in that property, we've got 2 data centers, actually. It's right on the Munich internet backbone. We've got an Amazon fulfillment center, last mile delivery. And so from that Amazon store or that Amazon fulfillment center, they can make 15-minute deliveries. And so, and a bell goes off in the Amazon when they get a very short window of delivery. and everyone rushes to get that one delivery out. It's incredible to watch. It's very it's just a really interesting place to go. We've also got in there 2 supermarkets. We've got a educational facility. We've got some service offices. We've got some long-term offices. Absolutely mixed use. The point of that about that building is that we love that tenant mix, because we can focus on the right tenants where we see rental growth.
Yep.
In that particular property, but ultimately there's additional value there. It's such a great location. It's a historic building, but ultimately we have the redevelopment of that building, that redevelopment opportunity at some point in the future. That's probably 10 years away. But we can then rebuild into a more modern building if we think it's the right time as well. I love that building.
Do you see that as the future, or that's just where there's opportunities, that's where your active management will go?
That's one potential exit. And as asked earlier on, what do we look at the beginning? I said we're always looking at the exit. One exit may be when it's fully let to the right tenant mix, and we've maximized what we think the rent is, to sell then to another institutional or even syndicated investor, or it may be to redevelop it. Those are 2 options. We're always looking at those, and whichever makes the best economic sense to us, we will choose.
I've got a question for you, Drew.
I've been stealing all the good ones. So.
Yeah, I've got to make up my own. So sounds, where does this fund fit in a retiree portfolio? Where do you use it? And I'm asking a rhetorical question because obviously it's our portfolio, but where do you use it? Where do you see it? Is it a cash subsidiary? Does it replace equities? Does it fit as a hedge in the growth alts down the bottom? Where do you put it, and what role does it play?
I think a big measure that I've always used, and I think we've always used in separating assets, is the volatility of the capital, even though it's valued pretty regularly, and what the downside risk is. So where we've tended to place it is between, we call it, for lack of a better term, medium risk asset. So you're talking about slightly more risky than bonds, not as risky as equities. If that kind of gives some spectrum. So it's kind of an alternative real asset.
Which is a bit different than a lot of other financial planning firms that would put it into the market bucket with their shares and their global shares. So for us, it actually sits pretty much in a defensive bucket, maybe at the bottom of that defensive bucket, being the most kind of growth orientated of the defensive bucket. But in these times, when interest rates are really low, then portfolios that will be successful over the next 10 years have to be built, we think, through a different lens or a different scale. And Invesco is definitely helping us do that. Now, last question, Simon. We ask this to the equity managers all the time, and they always have an answer. So the pressure is on you. You're 65, you're retired, and you only can buy one property in one region, and you can't sell it for your retirement. So what property is it? Or a portion, assuming that everything's $165 million you buy.
Firstly, being slightly kind of cute, I would buy this fund.
Yeah, good one. Move on. You've got to be specific.
To buy a specific property around the world. It would be nice to actually have been asked this, perhaps, right at the the question was coming before I was coming on to that. So what would I like? So the characteristics I'd like would be to be in a very long-term resilient market. So that's probably even in a CBD location, because then there's a huge amount of value in the location. And I could pick a number of different locations around the world. Being in the UK, the easy one for me would to be picking a building in London.
Not going out of fashion.
And if I was going to pick a building out of our portfolio in the UK where I am, then I'd pick a building in a place called Manchester Square, which is one we own. It's right in the heart of the West End. That has, well,
is that office?
It's an office building. And I like it for being an office building.
Yep.
It's in a location which has been relevant, frankly, for the last 100 years. It will continue to be relevant for the next 100 years, beyond my lifetime, certainly. And so what you'll take away from that is, firstly, I am still a fan of offices.
Yep.
They're needed. I'm a fan of having very well-located buildings. Ultimately, location is the thing you want to look at. And if you've got those two things. If you're an office building in a well-located place, tenants will always come because occupiers want to be in the best locations. They want to get the best access to their staff. They want to have great communications. And as long as you fill those locational requirements, then you tend to get long-term performance. So I'd be very happy with that building in my long-term portfolio. And for me, I could go and see it in 45 minutes, which would be.
I was sure you were going to pick San Diego for the weather, but
Well,
you don't live there, right? Yeah, it's just a best capital appreciation.
If it was down to weather, perhaps, but actually, I was looking at the investment reasons, not
making money. Yeah,
and you wouldn't be a property guy if you didn't answer the question with location. So
absolutely, it's completely key. Won't escape anyone. Yeah.
Well, on behalf of Drew and I and Wattle Partners and all our clients, we thank you for getting up at 5 a.m. for this podcast. Really enjoyed our time. Your fund plays a really important part in our portfolio. So thank you, Simon.
It's a pleasure. Thanks for seeing everyone.
Thanks.
Okay, guys, we'll see you next time. Episode 7, Drew, is it? And who do we have on?
Next Wednesday, we're doing a special session on superannuation, SMSFs, tips
Great,
and
with
traps,
Stephen.
and that kind of. Yep.
Excellent. All right, great, guys. Cheers.